They tell you gold is a relic, yet they're quietly buying more of it than at any time in modern history. They tell you to trust digits on a screen, bonds on a balance sheet, and paper promises backed by governments already drowning in debt. So why are the guardians of this system hoarding the one asset they keep insisting you don't need, and more importantly, what does that say about your future? In this video, we're going to walk straight into one of the biggest contradictions in modern finance: why central banks are aggressively accumulating gold while telling you that cash, bonds, and other pieces of paper are all you'll ever need. You're going to see how the people who design the rules of the game are positioning themselves for a very different future than the one they describe to you on TV. By the end, you'll understand not just what they're doing, but why they're doing it, and how it could affect your savings, your job, and the value of everything you own. Here's the uncomfortable starting point. Since 2022, central banks have been buying over 1,000 tons of gold a year, 3 years in a row, shattering records going back decades. At the same time, they continue to tell the public that gold is outdated, that inflation is under control, and that the safest place for your wealth is in government paper. That's like a ship's captain quietly putting on his life jacket while telling passengers there's absolutely nothing to worry about. You might not see the problem yet, but your instincts probably already feel it. To really understand what's going on, we need to zoom out. For most of human history, money was something you could touch. Gold and silver coins, physical metal, weight and purity stamped on them. If you held it, you owned it. But that system had a problem: it limited how fast governments and banks could expand credit. Every new promise eventually had to be backed by real metal. That constraint kept financial systems from blowing up too fast. But it also made it hard to fund wars, social programs, and big political promises. Fast forward to the 20th century. After 2 world wars, the world tried to compromise the Bretton Woods system. The US dollar would be linked to gold. Other currencies would be linked to the dollar. Gold sat in vaults. Paper moved around the world. It looked stable on the surface, but it contained a built-in tension. Governments wanted to spend more, borrow more, promise more. Gold didn't care. It just sat there, refusing to multiply. In 1971, that tension snapped. The US closed the gold window, ending the direct convertibility of dollars into gold. From that moment on, money became almost entirely an idea. A promise backed not by metal but by trust. Trust in central banks. Trust in governments. Trust that inflation would stay low. Trust that debts would always be honored. And you grew up inside this world, where money is mostly numbers on a screen, and the people in charge talk constantly about stability, targets, and confidence. But here's what nobody tells you: even after 1971, central banks never really abandoned gold. They just changed how they used it. For a while, many of them actually sold it off, insisting it was no longer essential. Those were the comfortable years: falling inflation, growing global trade, relatively calm geopolitics. It was easy to believe that spreadsheets and models had replaced shiny metal in a vault. But as the world grew more fragile, more debt, more political tension, more sanctions, that quiet relationship with gold started to change. Around 2010, central banks as a group stopped being net sellers of gold and became net buyers. Then, after 2022, their gold purchases exploded. In 2022, they bought over 1,080 tons of gold, the highest figure on record. In 2023, they added just over 1,030 tons more. In 2024, they did it again, exceeding 1,040 tons. These are not small tweaks. This is a structural shift. And it's happening while they tell you that everything is fine with the paper-based system. So what changed? Why is gold suddenly so attractive to the people who literally print money? Part of the answer is geopolitical. When Russia invaded Ukraine in 2022, something unprecedented happened. Hundreds of billions of dollars of Russian foreign reserves, held mostly in Western currencies and government bonds, were frozen. Overnight, one of the world's major powers discovered that its reserves were not really under its control. Other countries were watching, loudly. Imagine you're a central banker in an emerging economy that has occasionally disagreed with the US or Europe. You're holding a large pile of dollars and euros because that's what everyone told you safe reserves look like. Then you watch those same dollars and euros turned off like a light switch for another country. You ask yourself a very simple question: what can they not freeze, not delete, not sanction with a keyboard? Suddenly gold, heavy, inert, stored in your own vault, looks less like a relic and more like an insurance policy. But that's only one piece. Another is the mountain of debt the world has built on top of paper money. Global debt has soared to levels that would have been unthinkable decades ago. Governments owe, corporations owe, households owe. The whole system depends on low interest rates and constant refinancing. In that environment, central banks need people to trust paper promises more than ever. If investors, savers, and ordinary citizens start doubting the value of bonds and currency, the cost of that debt can explode. So here's the paradox: publicly, central banks must project total faith in the paper system, because that system is the foundation of everything: government budgets, pensions, mortgages, stock valuations. Privately, they are increasingly hedging that system with gold. For your money, they prescribe paper. For their own balance sheets, they are quietly choosing metal. Let's talk about paper for a moment, because it's not just physical notes. When we say paper here, we're talking about all the layers of claims in the financial system: government bonds, central bank reserves, commercial bank deposits, money market funds. They're all promises, IOUs that depend on someone else doing what they said they would do. If you hold a government bond, you're trusting that government to repay you in money that still has purchasing power. If you hold cash, you're trusting the central bank not to debase it too fast. If you hold a bank deposit, you're trusting the bank to be solvent and the government to back it if things go wrong. Gold is different. It's not a promise. It's not someone else's liability. It just is. That's why it sits in the reserves line of a central bank's balance sheet instead of the liabilities side. When everything else is somebody owing somebody else, gold is the one thing that stands alone. And in a world where trust is getting stretched thinner every year, that matters. In recent years, central bank gold buying hasn't just gone up, it has changed in character. It's no longer primarily Western banks tinkering around the edges of their portfolios. The buying is being driven by emerging markets: China, Turkey, India, countries across the Middle East, Central Asia, and Eastern Europe. Some years, China alone has added hundreds of tons to its official reserves, often after long periods of silence where it reported no changes at all. Poland has aggressively increased its gold holdings, with its central bank president openly saying he wants gold to make up a much larger share of reserves. These are not random decisions. They are strategic moves. Now ask yourself, when was the last time anyone on mainstream TV told you? By the way, central banks are quietly buying record amounts of gold year after year. Instead, the message you hear is usually the same: gold doesn't pay interest, gold is risky, gold is old-fashioned. You're encouraged to keep your wealth in bank deposits, government bonds, stock index funds, assets deeply intertwined with the very system central banks are hedging against. This is where things get uncomfortable, because it forces you to confront a hard truth: the system is not designed for you to think like a central bank. It's designed for you to be a reliable holder of their liabilities. Your role is to trust, to save in their paper, to work, earn, and store your time in assets that are easy for them to manage, control, and, if necessary, inflate away. Think about inflation. In the last few years, inflation surged in many countries, eroding the purchasing power of salaries, savings, and pensions. Central banks initially called it transitory, then gradually admitted it was more persistent than they thought. Meanwhile, gold quietly climbed and central banks kept buying. They can't say, "We're worried about our own currencies in the long term, so we're loading up on gold." That would be like a firefighter telling you, "We're reinforcing the fire station with concrete, because this city is a tinderbox." Confidence would shatter. But look at their actions instead of their words. In 2015 to 2019, central banks accounted for around 1/10 of global gold demand. By 2024, their share had risen to roughly a quarter. In plain language, they are becoming one of the dominant forces in the gold market. That's not a hobby. That's a strategic pivot. So what exactly are they afraid of? It's not just sanctions or one particular conflict. It's something deeper: the fragility of a global system built on trust in a few key currencies, especially the US dollar, at a time when political relationships are fracturing. If you're a central bank in a country that doesn't fully trust the US, You might still use the dollar because everyone else does. But in the back of your mind, you're preparing for the day when using that system comes with too many strings attached. Gold is your exit door. Now, let's bring this down to your level. What does any of this have to do with your life after all? You're not a central bank. You don't have vaults or tons of metal. You have a job, bills, maybe some savings, maybe a mortgage. You live in the world they manage, not in the meeting rooms where they write the rules. Here's where it gets real. Every time central banks and governments respond to a crisis, whether it's a financial meltdown, a pandemic, or a geopolitical shock, they reach for the same toolkit: lower interest rates, more money creation, bigger deficits. Maybe you remember the financial crisis, the bailouts, the unconventional policies. Maybe you remember the sudden surge of money during the pandemic years. Each time, the message is, don't worry, we've got this under control. Each time, the underlying debt and money supply grow. Each time, your future purchasing power quietly takes a hit. In a world like that, what looks safer, a promise printed on paper, or an asset that has been recognized as money for thousands of years? Central banks are answering that question for themselves with their own actions. The troubling part is that they're not exactly shouting that answer from the rooftops. But here's what nobody tells you: this isn't a conspiracy. It's incentives. Central banks are not evil masterminds. They are institutions trying to keep a very fragile system running. To keep it running, they need you to do one thing above all: believe. Believe that your salary will hold value. Believe that your pension will pay out. Believe that government bonds are risk-free. Believe that the currency you're paid in will still buy things 10 or 20 years from now. What happens if people stop believing? The system doesn't just wobble. It can seize up. Interest rates spike as investors demand compensation for the risk. Governments struggle to roll over their debts. Banks face runs as depositors pull money. Markets plunge as valuations reset to a harsher reality. That's the kind of panic central banks are built to prevent. And ironically, the best way to prevent it is to maintain absolute public faith in the very paper they're hedging against. So they walk a tightrope. On one side, the public narrative: inflation is manageable, the system is sound, our tools are effective, you can trust our paper. On the other side, the balance sheet reality: record purchases of an asset that exists precisely because paper can fail. It's a delicate balancing act, and you're not supposed to notice the second part. Take a moment and ask yourself, if the world were truly moving beyond gold, if it were really nothing more than a shiny commodity, why would central banks, arguably the most sophisticated financial players on the planet, keep loading up on it? Why wouldn't they just put everything into their own bonds, their own currencies, their own digital systems? This is the turning point in the story. Gold is not their plan A. The paper system is. But gold is quietly becoming their plan B. And history suggests that when powerful institutions build a plan B, regular people should at least know it exists. Think of gold as the fire escape on a very tall building. On a sunny day, nobody talks about it. The main entrance looks fine. The lobby is polished. People go in and out, confident that the structure is solid. But high up, behind the scenes, the building's owners are quietly checking the fire escape, making sure it's oiled, accessible, ready. Central banks are doing something similar with gold. They hope they won't need it. They're planning as if they might. Meanwhile, you're being encouraged to pile your life onto the higher floors: more leverage, more debt, more exposure to markets that rely on low interest rates and stable currencies. Your retirement fund is stuffed with paper promises. Your home, your salary, your savings, all priced in terms of a currency whose value depends on decisions you don't get to vote on. Does that mean paper money is about to collapse tomorrow? No. Systems like this don't usually implode overnight. They strain, they creak, they experience crises, then get patched up with new rules, new acronyms, new interventions. They last longer than the critics expect, until one day they don't. The point is not to predict the exact moment of failure. It's to understand the direction of travel. And the direction of travel is clear: rising debt, rising geopolitical tension, rising demand for gold from the very institutions that issue the paper. That's the pattern. You don't need a PhD in economics to see it. You just need to pay attention to what they do, not only what they say. So where does this leave you? It leaves you with a choice. You can continue to treat money as something abstract that just works, Or you can start to think about it the way central banks do, as something whose value can change, whose risks can shift, whose future is not guaranteed. You don't have to become a gold bug. You don't have to dump every piece of paper you own. But you do need to grasp that the people running the system are not banking solely on their own paper, and neither should your thinking. This is not financial advice. It's a perspective shift. You've been trained to think of money as neutral, safe, boring. Central banks, by their actions, are showing you that money is strategic, contested, political. Gold is their way of stepping slightly outside the system while still sitting at its very heart. That alone should make you curious. Imagine explaining this to your future self. 20 years from now, you look back and say, central banks were quietly doubling down on gold, governments were more indebted than ever, and I just assumed everything would work out because that's what they told me on TV. Would that feel like a responsible story to tell, or would it feel like you missed the biggest signal in plain sight? Here's the core insight in a world of paper promises. The real power lies with those who hold assets that don't depend on anyone else's promise. Central banks know this. That's why they hold gold. They may print money, but they don't trust it completely. They may issue bonds, but they don't rely on them exclusively. They run the system and still they want something outside it. You don't have their tools, their balance sheet, or their influence, but you do have one thing they can't control: your attention. Where you choose to focus it, what you choose to question, whether you take their words at face value or look at their actions and draw your own conclusions. So when you hear officials telling you that gold is outdated while quietly stacking it in their vaults, remember these systems don't advertise their weaknesses. They hide them, they manage them, they hedge them. If this video has opened your eyes even a little to that reality, don't let the insight fade when you close the app. Think about how you store your time, your work, your future. Think about which parts of your financial life are built entirely on paper. And ask yourself honestly if the people at the top are preparing for a world where trust in paper is not enough. Shouldn't you at least be aware of that? If you found this story challenging, stay with us. This conversation isn't over. It's just beginning. There are more hidden tensions in the financial system, more quiet moves by powerful players, more contradictions between what you're told and what's really happening. And the more you understand them, the less likely you are to be blindsided by the next unexpected crisis. So as you step back into your day, carry this simple mental model with you: watch what they buy, not just what they say. Because when central banks hoard gold while telling you to trust paper, they're revealing something they'll never put in a press release: their deepest fears about the future of money.